Have you ever bought a stock, watched it drop, and panicked into selling? For many, investing feels exactly like walking into a casino. Even very smart people lose money because they build their entire strategy on a shaky foundation. Buying a stock based on a single news story is like balancing your wealth on a one-legged stool. It will collapse. Professionals use a stable framework called the FTP method. It acts as a three-legged stool, built on fundamental, technical, and personal analysis. When your decisions are supported by all three of these pillars, you stop guessing. Instead, you can safely identify sleeping giants, great companies that are sitting there at massive discounts, just waiting to be noticed. The first leg is fundamental analysis. This tells you what to buy. Think of it like a doctor examining a patient. Before prescribing anything, a doctor runs tests to check your internal health. For a company, those tests are its three main financial records. The income statement shows if they're actually making a profit. The balance sheet compares what they own against what they owe. And the cash flow statement proves whether real money is actually moving through the business, since you cannot fake cash. To read these records quickly, we use this dashboard, 4 magic numbers that act as an automatic filter for quality. We look for a low PE, which is like finding the same apples at a much cheaper fruit stall. We look for a low PTB, which means you're buying the company's physical buildings and equipment for less than they're actually worth. And we look for a high dividend yield. Think of that like collecting monthly rent just for owning the stock. Our final check is ROE, or return on equity. This is our efficiency test. If you hand a business $1 and they can turn that into at least 15 cents of new profit year after year, that company is a world-class profit machine. By checking these signals, how cheap the price is, how much the assets are worth, and how efficiently they use your money, you ensure you're buying a business that is built on solid ground. It makes the first leg of your investing stool solid steel. But here is the catch. You can find a financially perfect company and still lose money if you buy it at the wrong time. That brings us to the second leg, technical analysis, which tells you exactly when to buy. This style represents a concept called the optimism strategy. It tracks the market's current season on a scale from 0 to 100, measuring the emotional extremes of investors. When the dial swings past 75%, we enter summer. The market is in euphoria. Prices are peaking, and everyone is bragging about making money. This is a very dangerous time. It is exactly when beginners are rushing in to buy, while professionals are quietly selling to protect themselves from an impending crash. On the other end, when levels drop below 25%, we hit winter. The news is terrible, and fear is at its absolute maximum. Prices crash to the bottom of the valley. But for a prepared investor, this is the best, safest buying opportunity you will ever get. By patiently waiting to enter during market winter, you get to buy a healthy company at the exact moment it goes on clearance. That locks in your second leg. The third leg is personal analysis. This is the psychological side of investing. It is how you figure out why the crowd is pricing a stock incorrectly. Think about that euphoria state again. When the general public is excitedly showing off their stock portfolios at dinner parties, the crowd feels safe. But because everyone who wants to buy has already bought, there is nowhere for the price to go but down. That excitement is actually a signal of maximum hidden risk. The opposite happens during capitulation. This is the moment of peak panic. The news is entirely negative, and terrified sellers throw in the towel, dropping the stock for whatever cash they can get, acting like a herd blindly running over a cliff. Warren Buffett summed up this contrarian mindset perfectly. He said, "You should be fearful when others are greedy, and greedy when others are fearful." Mastering your own psychology prevents you from panic selling at the very bottom. It gives you the conviction to act when everyone else freezes. With that, the third and final leg of your strategy is securely in place. Even a perfectly built three-legged stool will topple over if you set it down on quicksand. To stay stable, you need to spread your wealth across different types of investments, from cash and bonds to property, so you aren't gambling everything on a single market. We divide your capital using the 3 buckets of wealth concept. This ensures you are never overexposed to a single risk. The first bucket holds cash, purely for safety and emergencies. The second bucket is for passive income, like real estate trusts, which pay you a steady return while you wait. The third bucket is for capital gains, reserved exclusively for those undervalued sleeping giant stocks we found earlier. By spreading your money this way, you protect your total wealth. If one specific sector hits a rough patch, the other buckets keep you stable, ensuring you survive market dips and thrive over the long run. Let's look at the complete, repeatable checklist. First, you find a healthy company. Second, you wait for the technical winter season. And third, you step up and buy when personal analysis shows everyone else is too scared. When you follow these steps, investing stops being a stressful guessing game. It transforms into a reliable, repeatable system for building a resilient and lasting financial future. Now it's your turn to put this into practice. Pick your favorite stock and run it through the 4 magic numbers. Does it pass the test? Drop your findings in the comments below. I can't wait to see what you discover.